Welcome to the deep dive. Today we're zeroing in on SoundHound AI, the voice tech player trying to carve out its space against the big guys.
Right.
And you asked us to dig into the sources to figure out one key thing. Is the momentum we're seeing, this huge revenue jump, is it signaling a real sustainable growth phase? Or is the stock just, well, running on hype?
It's a classic setup, isn't it? High growth story meets tricky valuation, and the sources, they definitely pull in different directions.
So what's our mission today?
Our mission is really to cut through that noise. We need to reconcile these two narratives. You've got strong operational points, unique tech, smart acquisitions, that big customer backlog.
Right.
But then you've got these fundamental financial metrics just flashing warning signs about the price. So we'll dissect the tech edge, the strategy across different markets, and figure out what the risks really mean if you're thinking about timing.
Got it. Okay, let's start where the action seems most immediate. They're focused on specific industries, vertical specialization. They're betting big on automating order taking, especially in fast food, right? Quick service restaurants.
Exactly. And that's smart because they're hitting a huge immediate pain point in the market. The sources really hammer this home. The QSR sector, fast food, has massive labor problems. We're talking industry turnover around 7.4%. When you're bleeding staff like that, finding a reliable AI to take orders isn't just nice anymore. It's becoming a real necessity.
Right, desperate need territory.
Yeah.
And their answer is this new AI platform for restaurants they launched, back in February?
Yeah, Feb 25th this year.
And the key thing the sources stress is that this isn't just some generic chatbot. It's built for the chaos of a drive-through. So what's the secret sauce? What are the tech moats? Why them?
Okay, two main things stand out, and these are crucial for their whole growth narrative. First, there's their Polaris advanced speech recognition.
Polaris, right.
This is all about accuracy in noise. Think about it. Drive-through, engine noise, maybe kids screaming in the back seat, music. The AI has to understand the order correctly, even with complicated combos or changes.
Makes sense. Accuracy is table stakes there. But the second one, that proprietary architecture, speech to meaning, that's one that gets talked about a lot. Why is that such a big deal for speed?
Yes. Because it basically shortcuts the usual process. Most standard voice AI, the kind from the big tech giants, usually go speech to text and then text to meaning. 2 steps.
Okay.
SoundHound's tech, it claims to go straight from speech directly to understanding. 1 step. They skip that middle text conversion.
I see.
And by doing that, they cut out latency. They can get sub-second response times, which, as you can imagine, is absolutely critical when someone's waiting in line. Speed is their edge against the generalists, really.
And that speed, that accuracy, it translates directly into money for the restaurant, doesn't it? It's not just about cutting labor costs. It's about boosting sales. What do the numbers look like there?
Yeah, the monetization angle is pretty compelling, driving both sides. Efficiency and revenue. So, first, upselling. The AI never forgets to ask if you want the drink, the fries, the upgrade.
Right.
The data cited suggests the AI hits 100% upselling penetration. Compare that to the human average, which is apparently only around 42%.
100%. That's relentless. Good for the restaurant, maybe slightly annoying for me when I just wanted the burger.
Possibly, but highly effective, yes. And then there's throughput. Getting more cars through the line faster. Their smart lane technology, they claim, improved that flow by 15% to 20% during peak times.
15 to 20% during lunch rush. That's huge. That's potentially 1 extra car out of every 5. That adds up fast.
It really does. Significant revenue lift, not just cost cutting.
And it seems like big chains are buying in. The sources mentioned validation isn't just theoretical. They've got over 10,000 locations signed up, including places like White Castle, Chipotle.
Lobster. Deploying across their entire network. That's the world's largest seafood chain. That's not a pilot program. That's serious enterprise adoption.
Okay, so that scale really backs up the QSR specialization story. It shows the tech works in complex, real-world operations.
Definitely validates that part of the thesis.
The QSR proves the vertical focus works. But like you said, to justify the kind of valuation we'll get to later, they need more than just restaurants. What's the bigger picture? The 3 pillars.
Right, it's a broader strategy. 3 pillars designed to weave their voice AI into, well, pretty much everywhere you might transact. Pillar 1 is the foundation, powering devices.
Cars, IoT stuff.
Exactly. AI assistants in cars are a big one. They're in over 20 car brands. Jeep in Europe via Stellantis is a good example. And the revenue model here is royalty-based. Usually a one-time fee for the tech embedded on the device, plus recurring fees for cloud connections and services.
Okay, so devices first, then Pillar 2 moves into the enterprise space, right? AI customer service.
Yes. This targets the big guys, banks, insurance companies, Fortune 500s. They've rolled their tech into the Amelia 7 platform. Apparently, 15 top enterprise clients are already moving over to it. And the key buzzword here is agentic AI.
Agentic AI. Okay, let's pause there. We hear that term a lot. Is it just a fancy chatbot, or is there something genuinely different that matters to, say, a bank?
No, it's meant to be a significant step up. Agentic AI implies the system can do more than just answer questions. It can take action, it can maintain context over time, handle complex multi-step tasks.
So like,
Like for a bank, maybe handling a detailed loan query, it could
yeah.
pull your data, run a quick scenario, draft, and send a confirmation email, all without needing a human to step in.
Ah, okay. So it actually does things.
Yeah.
Reduces the need for human escalation.
That's the goal. Cut costs, improve service.
And Pillar 3 connects it all. Voice commerce.
Exactly. That's the ambition. Linking Pillar 1 users like you in your car with Pillar 2 opportunities like ordering from a business. They showed this off at CES 2025.
The hands-free ordering example.
Right. Ordering coffee, groceries, whatever, straight from the car system, hands-free. The sources estimate this market alone could be worth over $30 billion by 2030. They want to be the underlying tech making those voice transactions happen.
Okay, that's a big vision. And to get there fast, they've been buying companies. This M&A strategy seems pretty central.
Yeah, they call it programmatic M&A. Basically, treating acquisitions as an ongoing capability, not just one-off deals. The Amelia acquisitions is the prime example.
The $80 million one.
Yeah, $80 million in cash and stock. But it instantly gave them access to Amelia's existing Fortune 500 clients, global banks. That one deal is expected to bring in $45 million plus in recurring revenue just in 2025.
So it buys them market access and revenue scale much faster.
Yeah.
Helps bridge the gap to profitability.
Precisely. It accelerates the whole timeline.
And speaking of accelerating, the numbers do reflect that.
Yeah.
Let's talk financial momentum, the top-line growth.
It's a pretty explosive, no denying that. Q2 2025 revenue was up 217% year over year, hit $42.7 million.
Wow.
And based on that, they bumped up their full year guidance, now expecting between $160 million and $178 million for the year.
And the metric everyone points to for validation is that backlog, right?
Absolutely. They're reporting a $1.2 billion customer backlog. That's huge. Provides a lot of visibility into future revenue.
But there's always a but.
The but is that it converts slowly over the next 6 years, they say. So it confirms long-term demand, but it's not all hitting the books tomorrow. Still, it's a strong indicator.
Okay, growth is there. Demand seems locked in with the backlogs.
Right.
But the big question for skeptics is always profitability. What's management saying?
They're very focused on it. The target is to exit 2025 on an adjusted EBITDA positive basis.
Adjusted EBITDA positive, so operationally cash flow positive before all the accounting adjustments.
Essentially, yes. Earnings before interest, taxes, depreciation, and amortization adjusted for certain items. Hitting that milestone would be a major proof point that the core business model works and can generate cash.
Okay, so now, the collision. The moment of truth, incredible growth, cool tech, meeting some pretty brutal valuation numbers. This is the core tension, right?
Yeah. This is absolutely the crux of it. You have to weigh both sides. If you just look at the technical picture for the stock, the momentum looks strong. Indicators, moving averages, they generally point to a strong buy outlook.
Analysts seem generally positive, too.
Yeah, the consensus is a moderate buy with some high price targets around $18.67. They're clearly buying into the future potential of the AI engine.
Okay, that's the bull case from the charts. But the fundamentals, they paint a very, very different picture about the current price. What are the specific red flags?
They're pretty stark. The sources suggest that, based on relative value, SoundHound is maybe overvalued by 90%.
90%, wow.
Calculated fair value around $1.73 versus the market price, which has been hovering much higher, say around $17.85 in the source material. And the killer metric is often the price to sales ratio. TS, it's been around 55.1.
55.1, hold on. What's like a normal PS for a tech or software company?
The industry median is usually around 2.5.
2.5, so it's trading at more than 20 times the median PS.
Yeah, it's way up there. Northland Securities flagged this specifically, pointing out it's trading at something like 12 times forward sales for 2025 estimates. That kind of valuation basically assumes perfection. Flawless execution, market dominance in all pillars, everything going right.
Okay, so the valuation is pricing in a huge amount of future success already. Beyond that sticker shock, what are the other main risks investors need to keep an eye on? Volatility, for one.
Oh, yeah, it's extremely volatile. The stock's 60-month beta is 2.58. That means it moves, on average, more than 2.5 times as much as the overall market. Big swings.
That profitability isn't here yet, right? Despite the revenue growth.
Correct. The Q2 net loss actually increased 60% year over year to $37.3 million. And they're still burning cash operationally about $74.5 million over the last 12 months.
Which leads to.
The risk of dilution. When you're burning cash, you might need to raise more capital eventually, often by issuing more shares. That increases the share count and can hurt existing shareholders' value.
And we know there's a big crowd betting against this perfect execution story playing out. The short interest.
It's high, very high. Nearly 33% of the available shares were shorted as of early September, according to the sources.
33%, that's huge.
It adds a ton of pressure and volatility until there's a really significant, undeniable positive catalyst. That heavy short interest is likely going to act as a ceiling, sort of capping potential gains.
So for you, the listener, trying to navigate these extremes, timing becomes critical. What are the near-term events, the catalysts, that could either validate the bulls or give the bears more ammo?
Keep an eye on two main windows. First, the next earnings report, Q3, which should be out in early November. If they deliver another strong beat on revenue, maybe raise guidance again, that could force some shorts to cover and push the stock up.
Okay, Q3 earnings. And the second.
Perhaps even more important is the Q4 earnings call. That's scheduled for February 27th, 2025. That report will give the first real look at the financial impact of that big new QSR platform rollout.
Ah, right. We'll see the initial numbers from Red Lobster, Chipotle, etc.
Exactly. We'll get a better sense of the actual revenue conversion rate, the margins they're getting. Those numbers will be key to justifying, or maybe punishing, that huge gap between the current price and the fundamental valuation.
Okay, so let's try to synthesize this. SoundHound clearly has some impressive proprietary tech Polaris speech to meaning.
Yeah.
It seems to be solving real problems in specific markets like QSR and automotive. The growth is undeniably rapid, and there's a path, at least outlined, towards profitability.
Right.
But all that potential success, and maybe then some, seems fully baked into the stock price right now. The valuation assumes near-perfect execution.
That's the tightrope they're walking. And the core strategic tension long-term is this whole specialist versus generalist thing. SoundHound is betting on its deep vertical expertise in voice AI to compete with the sheer scale of Amazon, Google, the big tech players.
Which leads us perfectly into our final thought for you to chew on after this deep dive. SoundHound's whole strategy relies on maintaining these technological moats in specialized areas like restaurant ordering, like agentic AI for banks. But here's the question. Can a company truly succeed long-term just by being the best in niche verticals? Or will the massive resources and generalized capabilities of big tech eventually overwhelm them, forcing companies like SoundHound into just niche survival? Or maybe an acquisition by one of the giants wanting their tech.
It's that specialist versus generalist battle playing out right now in the AI race. Definitely something to keep watching, especially as those next couple of earnings reports land.
Indeed. Well, that's our deep dive for today. Hope you feel thoroughly informed. We'll catch you next time.